In our last lecture, we ended by looking at this chart. And I hoped that you would take a few minutes before coming into this lecture to try to fill it out, to just grind out the numbers. Because we're going to use the numbers in a little while to do some graphing, but I really feel just to wrap your brain around this whole idea of this is national income accounting, for you to just take a moment to look at the numbers. If you didn't, stop the lecture here and just do yourself a favor. Take 10 minutes, grind out the numbers. All right, now when we come back and look at the numbers, this is what you're going to find. Hopefully these are the numbers that you got. You put the 900 in here, you multiplied it by 0.6, you should have gotten 820. Income 900 minus 820 is 80. In order to get the marginal propensity to consume, we really can't do it for this level, although I've put it in, because you don't know what would happen before. All right. But your average propensity to consume is 0.91. You took your consumption of 820 divided by 900 and got 0.91. You took your savings of 80 divided by 900, you got 0.9. Now, just as I told you last time, if you add the marginal propensities together, that has to equal 1. If you add the average propensities together, that also has to equal 1. All right, so hopefully you were able to get these numbers. Now, first thing, we notice that the marginal propensity to consume is 0.6. It stays 0.6. And what you notice is this 0.6 is the same as this. B in our consumption function is the marginal propensity to consume. Now, why do I ask you to calculate it? Well, if you use the marginal propensity to consume up here to calculate your consumption levels, and then you use your consumption levels to calculate your marginal propensity to consume, if these don't equal this, then you did something wrong with your math. It's a good way of checking your math. All right. And since we know these have to be equal, you can check your math. If you do the calculations here with savings and income, if they don't equal what you're supposed to have here, again, another way of checking your math. All right, now, not more importantly, but of more interest are your average propensity to consume. Look, as your income goes up, on average, you consume less. Maybe my husband's right. Maybe I do spend more money than Bill Gates, on average at least. All right. If your average propensity to consume drops as your income goes up, that must mean your average propensity to save, as income goes up, your average propensity to save has to go up, right? This is the foundation upon which some very conservative politicians and conservative economists argue for tax breaks for the rich. Give the rich more money, and guess what? They're going to save more. On average, they save more. Now, why do we care about that? Savings is extremely important. We need businesses to save money. If you think back at that circular flow diagram where we added in the banking system, we need savings in order to have money to invest. If you don't have savings, you can't have investment. All right, so savings is very important. Now, when we talked about equilibrium before, we always talked about where supply equals demand. Well, guess what? We don't have a supply curve and we don't have a demand curve here. How can we possibly find equilibrium income? Equilibrium income is defined as the income level at which the economy is stable. Okay? The income level at which the economy is stable. That's what Keynes was looking for. Keynes wanted to find an income level at which the economy would come to rest. Now, in this example here, remember this S is savings here, so it's not supply. In this chart, we have to find something to represent the total demand being done in the economy, or aggregate demand, and the total supply being done in the economy, or aggregate supply. All right. Now, if there are only two players in the market, producers and consumers, how do we determine the total demand that these two players together want? Well, we know what consumers want is measured by consumption. We know what producers want is measured by investment. So C plus I here, the reason I asked you to calculate C plus I, that's total demand for the economy. Now, we don't have anything here that represents total supply, but we know in equilibrium, supply equals demand. In our circular flow diagram, we know that the total amount of goods and services produced in the country has to equal the total income created in the country. All right, so if C plus I is the total demand, guess what? Y represents total supply, because this is the total income created in the country. And guess what? Look right here. At an income level of 1,100, total supply equals total demand. We found our equilibrium income level. We have found the income level at which our economy is stable. That's what we want to move it to. All right. Now, we need to do some graphing. We need to graph equilibrium income. Now, in order to graph equilibrium income, we're going to put consumption and C plus I here, and we're going to put YD here. So if we go back to these numbers, if you go over so many units of income, go up so many units of consumption, you do that for all three levels, plot them, put the points in. And that would be graphing the consumption function. If again you used YD, but now you use C plus I, that would give you our total demand line. Do me a favor, use this graph, pause the slides here, and graph C and CYD and C plus I YD. All right, and let's take a look at what they're going to look like. Now, hopefully you've taken a moment to graph your C plus I line and your C line. Now, please note something very important, that the C line does not start at the origin. It starts up. And remember, along this axis, income equals 0. So if you go back to the original consumption function, how much would consumption be if you had no income? Well, that would be your autonomous consumption, and the graph that we looked at, that was 280. So our consumption function starts here at 280 and goes out. Now, we know that I is 160 for all income levels. So C plus I, when income is 0, is going to be 440. That's 280 plus 160 is 440. So you've got these two lines. Now you notice there's a third line here that we haven't talked about yet. That is a 45-degree line. The 45-degree line represents all of the places where the value along the horizontal axis equals the value along the vertical axis. Which means if I go over 5 units and up 5 units, I'm on the line. If I go over 2,000 units and up 2,000 units, I'm on the line. Right? So for us, this 45-degree line represents all of the possible places where total supply equals total demand. Right? Now, how do we graph equilibrium income? Well, if this line, the 45-degree line, represents all of the possible places where total supply equals total demand, and C plus I is exactly what's happening in our economy, then where these two intersect becomes our equilibrium income. This would be 1100. All right. Let's pause the slide and take a moment to think about that and see if there are any issues with it. Now, the purpose for Keynes to find equilibrium income is because he wanted to compare that with something he called potential GDP. Potential GDP is the income level, or is the maximum GDP level we can have without creating a recession or inflation. So the potential GDP is basically being on your production possibility curve. Now, what Keynes wanted to do was compare this potential GDP with equilibrium income. Now, if the place where your economy comes to rest equals your potential GDP, then you're fine. You're in a great place. But what happens if the economy comes to rest at a point other than at potential GDP? Well, you got a problem. Two things can occur. You can have a deflationary gap, and a deflationary gap occurs when your potential GDP is greater than your equilibrium income. So the economy has come to rest below your potential. Guess what? You're under your production possibility curve. An inflationary gap, the other side of the coin, occurs when your potential GDP is less than your equilibrium income. What's happening here is demand is so much greater than supply, you are causing prices to rise rapidly. Now, if we wanted to put these on the graph that we just had, this is what you'd see. I took the consumption function out of here just to make life a little easier. So here we are. If we have a potential, if our potential GDP is greater than our equilibrium, we have a deflationary gap. If our potential GDP is less than equilibrium income, we have an inflationary gap. Now we've got a problem here. This isn't good. We either have a recession over here when we have a deflationary or recessionary gap, or we have inflation over here. These are two big problems in the economy. Now, remember what the Keynesian revolution is. Keynes argued that if your economy comes to rest at a point other than your potential GDP, then it's possible that government intervention is a good thing. So now our issue is, how do we move forward when we have these gaps? All right, we're almost done with this lecture, so let's wait until the next lecture, okay, to start looking more at that. All right, thanks.